Good morning. My name is John Charalambakis. I'm the Managing Director of BlackSummit Financial Group based in the United States, and we welcome you this morning on ESG and carbon trading. Our panel today is consisted of Petar Slavov from ProCredit Bank based in Bulgaria, Mrs. Rachel Poole from BlackSummit Financial Group in the United States, and Roderick MacDonald from Finance in Motion based in Germany. Unfortunately, we're missing Dr. Tsibanoulis from Greece, a legal expert on ESG and banking, but I will try to summarize a few points from his presentations. We have a surprise for you. At the end of the presentation, we will announce the winner of the US presidential election on Tuesday, November 5th. So wait for that. On Sunday, August 15th, 1971, we had a financial earthquake since President Nixon announced that he's going to delink the dollar from the gold. On August 15th, again, September 15th, 2008, we had another financial earthquake, the Lehman Brothers collapse. What is the common point between those two events? We had over-hypothecated assets. We were lacking collateral, and the financial markets were collapsing. That brings us to a conclusion, potentially, of our session. We are lacking assets. We have rehypothecated financial assets, and therefore, in order to solve the problem, we need new assets in order to generate credit. So in the ESG and carbon trading, so what would be the new asset class? Would be carbon trading. The Wall Street Journal estimates it's going to be a $22 trillion market. Right now, it's approximately $1 trillion. Here are some facts. Fact number one, there is climate change. Fact number two, we're missing collateral and we need financing. Fact number three, we need to standardize processes. Fact number four, we need technologies and incentives to eventually create this new asset class. And the last thing, certainly, that we need is to create a one-stop shop for this new asset class to materialize. So I would like to start with Petar and his views on renewable energy and banking and the challenges that we have.
Thank you, John. Let me pick it up from where you started and finished, and adding one fact more. All what you say is absolutely correct, but fact number 5, in my opinion, is that we should do all these things without repeating the mistakes, resolving the previous crises and problematics we have created. And more or less, you can see already the danger for this. We are international group which came to the Balkans and Eastern Europe 40 years ago. Would we be able to show what I have? Or no? No problem. Don't worry. We also came in Greece 2014, exactly in the moment when everybody was leaving this country. And the last years, not because of our business model, and here I will talk about the difference between business modeling and behavioral approach when we speak about ESG and carbon trading. Nowadays, everybody is an expert in ESG, among them also myself. So, in certain aspects, don't take me that prominently. Talking about ESG and talking about carbon trading, there are two different approaches. The one is the compliance approach, business modeling, and I see we're all going that direction, training everybody around, whoever is aware of the topic. And if I take 100 people I know, not only from my professional environment, but also from my social one, not more than 10 knows exactly the terminology ESG, and no more than 2 knows what exactly it means. So we are training people now just ticking the boxes and more or less staying around protection of the environment and presenting this as a ESG approach. And this is the compliance approach I'm referring to. Too far from the behavioral approach, where not just trying to pay for your sins in every different versions you might see it, but behaving that way. And here comes the topic of the education of the society and the education of the people around us. The same way we take our approach towards educating our children. Unfortunately, too far in the area of ESG from there, and the difference is that we simply don't see the consequences we create with this compliance approach, just trying to facilitate certain requirements. I can go deep in these topics, and can speak about renewable energy projects, especially in the area of Greece and on the Balkans, in case we find enough time for it.
Thank you, Peter. 2 very quick questions, probably coming from Dr. Chipanoulis' presentation, who is missing. Question number 1, he says in his presentation that banks have not responded in a sufficient way to ESG challenges. As a banker, would you confirm that?
Yes, sure. Let me speak also about so-called net zero banking alliance, where you can find like 60 of the main players in the banking sector. Among them, banks like group like we are. The leaning among the members of this alliance, number 1, number 2, it's sweet. That's why maybe I'm here now. Number 3 is Triodos Bank. We're occupying the first 3 seats, but practically we are talking about 20 to 22% of our revenue. Coming only 22% from our revenue coming from sustainable sources. Okay. It's too far from the compliance target. What about the behavioral one?
Very good. I may revert with the second question after Roderick's presentation. So, Mr. MacDonald, you're coming from a sector, you're managing over $3 billion, and you're focusing in South or Eastern Europe for renewable project. Could you please tell us what are the challenges and opportunities in the renewable sector?
Well, Southeastern Europe doesn't really have a lot of difference from a lot of the other places in Eastern, even Western Europe, in a lot of instances with regard to build out of renewable energy. My background is in investing in renewable energy power plants and infrastructure. I've been doing that since 2006 in Europe. So my night job these days is also lending or working for a debt fund that invests in. But the main brunt of my activities nowadays is launching an equity fund. The main challenges are really getting through permitting and.
Can I ask you please to be quiet in the back, please? Thank you.
Construction, permitting, etc. There is a backlog for grid connections in just about every country nowadays, where there is a strong build out and a strong regime and support for such projects. So the real bottleneck and the real difficulty is in getting good projects to market these days is really comes down to grid construction or grid infrastructure and grid connections, which really means that there's going to be a lot of investment, not in specific generation projects in the future that's needed, but storage, energy storage, whether that's battery or chemical in form of hydrogen or other chemical storage, and above all, grid connections. So it's infrastructure and storage really that will help the acceleration of the build out. And in addition to that, some streamlining of permitting processes throughout the region.
Very good. Dr. Tsipanoulis in his presentation says the lack of data sometimes challenges funding sources. And he also says if we are able to integrate credit risks into the evaluation of a project, probably we're going to increase the efficiencies and reduce the risks. So from your practical perspective, how do you integrate the climate risks when you evaluate a project?
Well, climate risk, there fundamentally is an aspect of climate risk mitigation, albeit very long term in these types of projects. But specific sites, specific projects might have certain issues with regard to potential flooding in a 100, 500 year event, etc. There may also be changes in wind patterns, particularly, but these are generally all things that are considered and reviewed in the various diligence and the various reports that are generated by wind or solar forecasting experts that need to be a part of every transaction. So really, it comes down to, at the end of the day, diligence to work in any type of climate risk that may be involved with a project.
Very good. And maybe one question for both Peter and you, Roderick. When we incorporate, let's say we have the ability to incorporate a model of climate risk or ESG risk, do you think there is potentially the trouble of getting too far and too much ahead of ourselves, so we increase bureaucracy, and when we increase the bureaucracy, eventually we reduce the rate of return to the investment?
Thank you for this question. Sorry.
Go ahead.
Thank you for this question. It was I like it so much that I couldn't resist to start answering. You are absolutely right. The process you're talking about, they don't start from modeling.
Yeah.
They start from building awareness. Mm-hmm. Building awareness among those who will evaluate the credit risk, and much more awareness among those who are going to be evaluated. I mean, the clients and the investors and etc. And in our case, especially, where we really focus on reaching not the big guys, but reaching the majority of end customers and SME companies and private individuals, Greece has a fantastic model with so-called energy communities, where you go and see a big photovoltaic park of 50 megawatts. We have financed plenty of such over the last 5 years. But behind this huge investment you see, you don't find one or two or five big players. You find like thousands of small investors, SME companies, family businesses, even private individuals, agro producers, unified in energy communities, and having a real direct benefit from this investment. So building the awareness, it's for me step number one, okay, and the most important priority nowadays before we really, enjoy the modeling processes in the credit risk
Thank you.
area.
Roderick, would you like to add something?
Yeah, so credit risk in terms of renewable energy infrastructure projects from the equity side is not so much of an issue for me. At the end of the day, I'm getting the debt up front, so it's I care about what happens between construction and financial close. From the debt side, wearing a debt hat, at the end of the day, what you're really looking at is there a robust regulatory environment? Is there a good resource that's going to enable the project to perform? Is it technically sound? And is there what's the threat of an impact on remuneration? So obviously those are all things that we take into consider and review when we're taking into any sort of credit concerns.
Thank you. Rachel, now the ball is in your court, since you're a good tennis player. How do we move from ESG to the new asset class that just in the year 2020 was worth $200 billion, in the year 2021 was worth $400 billion, 2023 close of close to $900 billion. So how do we create this new asset class called carbon trading?
Yes, so I'm glad we've got the bankers here talking about the ESG side, because what BlackSummit Financial Group has done over the last few years is spend a lot of time and energy and research into this emerging asset class that is carbon trading. And the purchasing or the generating of carbon credits, as well as the investment in carbon projects or renewable energy projects, are ways for companies to elevate their ESG rating and become ESG compliant, especially in the environmental side, which highlights a company's carbon footprint and the sustainability of its supply chain. And what we've had here in 2023 was the record-breaking year for global emissions. The globe generated over 41 billion tons of CO2. It was also the warmest year on record. And we've got 10 countries alone that make up 2/3 of emissions, with China, the US, and India kind of leading the way. So there's this awesome opportunity in carbon markets as companies are not only addressing ESG pressures, but also trying to meet that net zero emissions goal by 2050. Carbon markets will play a pivotal role. They have to play a pivotal role. There's no way that we can meet those net zero emissions standards without carbon trading. So this, like John already said, the carbon market is worth over $900 billion today and is expected to reach at least $2.68 trillion by 2028. So that's really just a few years from now. And Petar mentioned kind of the compliance market aspect of carbon trading, which is dominated by the EU ETS system, and there's obviously a lot of industries now, newly the shipping industry, that has been incorporated under the EU ETS system, that is having to meet the pressures of the emissions cap that the EU is implementing on them. But outside of the compliance markets, you have the voluntary carbon market that is emerging and becoming kind of its own. It's really building up the carbon as an asset class. It's moving from, okay, we have to meet these standards, to how I'm just meeting compliance isn't going to be enough. So how do I move my company from going to net zero? And let's see. On the voluntary market side, we're seeing this massive demand for carbon credits rising faster than supply, and that's going to continue expanding for decades to come. It's driven by those regulatory standards and those corporate commitments to reach net zero. And to achieve net zero, the global economy is going to need a growing supply of 7 to 13 gigatons per year. And so it's estimated that this explosion of demand is going to drive the value of voluntary carbon credits from the low kind of single digits, $10 range, to as high as $100 per ton in the next 10 years. So I don't know, does that answer your question?
Yes, but okay, let's put it practically.
Yeah.
Let's say I have a company called Texas Midstream Energy, and I want to emit more. So I need a carbon credit.
Yes.
Where can I find it?
Well, right now there's not a very centralized voluntary carbon market, which is one of the issues. Right now, buyers and sellers, exchange it on. They go with a broker, a middleman, or they do it between each other. But there's a lot of transparency issues, a lot of illiquidity, and there's too many middlemen. It's very decentralized. It's a fragmented market. So what BlackSummit actually is trying to do is create this one-stop shop for carbon trading, where they're not only advising people on the compliance market side of things, but saying we're going to offer the tools to, the essential elements. So there are actually 7 essential elements that we have said, is vital to kind of getting into the voluntary carbon market and being successful in the voluntary carbon market. And that first piece would be demand with this high-profile kind of clientele, and then verified supply of carbon credits, which means, verified being key because we want to avoid greenwashing, which is the big kind of controversial element of carbon trading right now. But then also a platform for data and analysis, so really putting emphasis on data, as well as, having an exchange where trading can be cleared, a trading desk, the digitalization of carbon assets so that we can increase transparency, tradability, liquidity, and then of course having a team with carbon experts that have years of experience, but also include carbon aggregators and partnerships with certifiers.
Very good, thank you. I would like to go back to the whole panel. Any thoughts as to how, Roderick, let's start with you. How you could collaborate, let's say, with a carbon trading desk to make your job easier?
Well, my current job doesn't have really any overlap with carbon, but to sort of back up for a second, I sort of jumped at the chance to speak at a conference again about carbon or carbon trading, because it's a topic that's very sort of close to my heart. I ran the transactions that made, I think it's the largest insurance company in Europe, but I spent a long time at a German insurance giant and made it carbon neutral back in 2010, 2013 to 13, and I did that via the voluntary carbon market. What the market infrastructure that it's a firm called Market. The market infrastructure that existed at the time was fairly basic and consisted really of a single carbon or voluntary carbon registry, but it really served the purpose, and it was really existed so quite well. The aspect that was missing was really a market, a transparent market that enabled buyers to find sellers without the use of an intransparent broker or the inability to see where your carbon was pricing at the end as well. So when I was buying carbon, so we probably did a couple of million tons at around $1.55 approximately back in 2010 to 13. I'd love to hear that it's maybe going to 100, but I won't hold my breath. But the most helpful aspect in terms of the whole trading or market would really have been a platform where there was a good transparent pricing market for it rather than just a registry.
Very good. I think it's time to open to you all if you have any questions, comments, objections. So we welcome your feedback. Please.
Do you have a preference over CCUS or nature-based?
Sorry, can you repeat that?
Do you have a preference on carbon capture From an investment perspective, which investment do you consider as more low risk? Nature-based reforestation projects or CCUS, carbon capture technologies? Have you done any analysis on that? And I'd welcome your thoughts. Thank you.
At the time I was doing carbon, yes, I really preferred nature-based. The carbon capture and storage, an engineering solution that I mean, the permanence question on both is there, but I felt that there was a lot more to be gained out of these nature-based solutions. In particular, one of my favorite deep peat forests that were being burned and effectively, releasing an enormous amount of, young coal into the atmosphere. I'm not doing it now, but my preference now in terms of carbon certificate solutions would clearly be a system where renewable energy would be generating it. But that's just because I'm an infrastructure investor.
Somebody else? Rachel, yes, please go ahead.
Sorry. If you go into the investment into infrastructure, especially if you go into, for example, wind power plants or something like this, do you calculate also the footprint of CO2 already? And what makes the difference between the lower footprint and a higher footprint? Because everybody knows that you need a lot of concrete inside the base, or because the foundation has a weight of 3,500 to 5,000 tons, so bigger ones, and you are able to reduce this up to 70 or 80% the CO2. So what is the value of the reducement of the CO2 in the base if you are able to reduce the CO2 footprint in the base about 80%? What is the perspective, or what is the view from the financial part? Thank you. Well,
the difference, there is a pricing difference in terms of green steel, green concrete. The solution that the engineering solution that's presented to you is very often. It depends when you enter the investment, but it's very often if you're coming in at a later stage already determined. But that's really one of the it gets to sort of the heart of one of the major questions about ESG and infrastructure, renewable energy, and carbon investing is what are some of the impacts of increased ESG scrutiny on a renewable energy project? And one of them is clearly, what are you using the most carbon-free or the greenest materials in construction? What's the price difference? And it really doesn't have much of an impact on the overall IRR or return of the project over the 30-year lifespan of it. But another aspect of that goes down into very similar is also that comes from the ESG aspect of or the impact aspect of investing in renewable energies is also the increased scrutiny on other aspects of the value chain, such as forced labor, etc. Maybe I didn't explain this correct. I'm not talking about just green concrete, because green concrete is one thing. But if you are able to reduce the amount of concrete inside the fundaments within 70 or 80%, then you're already on another level, and you upgrade the time not from a 20, 30 years to a 50 or 60 years. So you have a totally different view on this. That the question is how you look on this like a financing institute. Well, I mean, that's if you're talking about an untested technology, then clearly we want to see it tested. We want to see it before it gets implemented. If you can cut down the amount of concrete and give it a longer life, although in terms of turbines, it's not the foundation that's the issue. It's the turbine itself. Then all the better. But that would sort of be a magic solution that I just haven't seen.
And any other questions? And in order to close our panel, and before we thank you for your presence, Rachel, I think you're working with a publicly traded company, a well-known energy operator in the United States. They're trying to decarbonize. What are the benefits of decarbonization?
Well, the benefits of decarbonization would be, well, first to meet kind of those ESG criteria. I know a lot of public companies, at least the one that we're working with, is they're getting a lot of pressure from their investors and their stakeholders to decarbonize. And not only does it kind of help you meet that ESG criteria, it helps them meet the net zero emissions, beyond that. So it just elevates their company and makes them more attractive as investments, because that's what people are looking for. And in addition, it's allowing companies the opportunities to move from fossil fuel energy production into new energy resources. So a lot of these big energy companies in the U.S., big fossil fuel or electricity generation companies are having to move away from coal and towards these carbon projects. And not only they're just investing in carbon projects, but the trading of credits allows them to offset their emissions and for them to meet those environmental standards and goals that their investors are seeking.
Very good. So eventually they leverage their decarbonization.
Yes.
And as Dr. Cipanoulis says in his presentation, that standardization eventually increases the return on their investment and equity. Ladies, gentlemen, thank you for your presence. I hope you have a wonderful day.